Back to basics. What are bonds? How are you guys doing today? My name is Apple, and today, as always, we are filling in the financial gap between schools and the real world by helping you guys build some financial literacy skills. And the topic of this video today, what we're going to be talking about is what are bonds. So I'm sure you've heard of bonds before. I'm sure you know that they are an asset class similar to stocks. But beyond that, a lot of people just don't know anything. They just know that that's a thing I could be investing in, but I don't. So in this video, we're really going to dive deep into what actually is a bond, what does it represent, and then what can you actually do with it, the pros and the cons of bonds, and finally, we're going to talk about how you can actually get bonds if that is something that you're interested in. By the end of this video, I'll give you guys some resources and some brokers out there where you can actually go to get your investing in bonds started. So without further ado, we're just going to hop right in and be sure to share this video with a friend if you think they would get some benefit out of it. All right, so first off, what are bonds? Well, when we look at stocks, bonds, other asset classes, what we can really think about is whether we're investing in equity or debt. So when you're investing in a stock, what you're getting is you're actually getting a chunk of that company. You have partial ownership in that company, and therefore you have equity in that company. If you're not familiar with the term equity, made a whole video about it, so be sure to check that out above. But if you're investing in stocks, you have equity in a company, you own a share of that company. So with stocks, you are investing in equity. Whereas with bonds, you're actually investing in debt, because a bond is kind of like an IOU from either the government, a municipality, or like a corporation. So what the corporation or the government or whatever will do is they will use this thing called debt finance, which is where they go into debt to finance potential upcoming projects, to pay people, all this good stuff that they need money for. They will actually send out these bonds. They will release bonds to the public to buy, to be able to fund these things. So a bond is basically an IOU. So this corporation, this government, whoever is giving out this IOU, and they're saying, all right, if you give us $100 today, we are going to pay you back with, say, 3% interest over the next 10 years, so that over the next 10 years, we will pay you back with interest if you let us borrow your money today. So that is basically what a bond is. It's an IOU from the government, from a company, whoever, that allows you to basically fund their projects, pay their workers, all this good stuff that they need money for that they don't have money for right away. So it's basically a way to connect people with money to the corporations or governments that need money. So that is the basics of what a bond is. And with any kind of debt, there's going to be two main elements that you're going to be concerned with. You're going to be concerned with the when and the how of these payments for the debt. So the when comes in with the date of maturity. So every single bond is going to have a date of maturity unless it's a perpetual bond. We don't have those in the US, but there are some bonds that actually never do mature, so they just keep paying you interest forever. I know in the UK they have one of those, so that's pretty cool. But in the US, all of our bonds are going to have a date of maturity. And at this date of maturity, that is when the bond is going to be mature, and you are going to have received all of your money with interest back. So bonds usually have a date of maturity, say 10, 20, or 30 years out from the day that it is released. So if you hold the bond until that day, you get your interest payments, and then by the end of the date of maturity, you're going to have all of your interest back and all of your principal paid back to you. So at the end of the date of maturity, that bond is now worthless because you have gotten everything back. Then comes the how. So the how is your rate of interest. How much are you being paid for lending money to this person? How much are they paying you in interest for the privilege of borrowing your money? So that is something you really want to be concerned with your bond investing, because you want to know how much you're going to be getting paid by these people for letting them borrow your money. All right, and then with bonds, you always do have two options with your bonds. You can either hold them until the date of maturity, or you can decide to actually sell them before the date of maturity to somebody else who wants to hold on to it for a while. So if you decide that you would rather have less money now than more money in the future, you can always decide to sell that bond ahead of the date of maturity, ahead of when you have received all of your money back. Say you've gotten a couple interest payments and now you realize, okay, I actually do need that money. You have the freedom to sell that bond And for the most part, bonds are pretty liquid, except for municipal bonds. I'll make a video about those in the future. But bonds, for the most part, pretty liquid, pretty regularly traded. So you can definitely liquidate a bond investment if you need to do so. All right, so there's really three characteristics that you got to look at with your bonds when you are choosing a bond, when you're investing in bonds. There are three big characteristics that are going to be the most important things that you need to know about your bonds before you invest in them. And these are, one, what is the term of the bond? How long out is that date of maturity? Is it a long-term bond? Or is it a short-term bond? Is it a bond that is going to mature in 6 months? Or is it a bond that's going to mature in 30 years? So you got to know this up front, because the term of the bond is going to dictate how much interest they're going to be paying you. So if you buy a bond that's going to mature in like 30 years, they're going to give you a higher interest rate on that, because that signifies that you are putting more risk in this investment. It's a higher risk premium when you invest for a long stretch of time, because over that 30 years, there's the possibility for these guys to actually default on their bonds, and that's something we'll talk about in a little bit. But they could actually default, they could file bankruptcy, all of this stuff could happen over the next 30 years, which would result in you potentially not getting paid back. And anytime there's a risk of you not getting paid back, that is a risk premium, and you're going to be receiving a higher interest rate on any risk premiums. So that is something to keep in mind. If you got a long-term bond, it's going to have a higher interest rate than a short-term bond for the most part, because of that risk premium. Next thing to think about is the credit risk. So the credit risk of the borrower. So just like how a bank is going to assess your credit score when you apply for a loan, you got to be assessing the person who's putting out the bond when you are lending them money. So if you are lending money to, say, the government, they are going to have a pretty low credit risk. There's going to be a pretty low risk that the government is going to default on the money that they borrow from you, the taxpayer. So when you invest in government bonds, there's not a very high credit risk, and therefore the interest rate on the bond is actually lower, because like we talked about with risk premiums, there's a risk premium with a riskier borrower. So if the borrower is risky, then there's a higher chance that you're not going to be getting paid back in full, because the borrower is going to either default or go into bankruptcy. So that is going to get you a higher interest rate on that bond. So you got to keep that in mind as well. How risky is this borrower that you are lending to? And really risky borrowers are going to put out what we call junk bonds. And these are bonds from people who are not very reliable. There's a very decent chance that they file bankruptcy, that they default on their loans. So those are things that are kind of more in the speculation spectrum of things. They do pay pretty significant interest rates. However, there's also a pretty significant chance that you actually don't get all your money back in the end. So that is definitely something to keep in mind. If you're interested in junk bonds, be sure to check out some resources in the description about those. I'll definitely put some stuff down there about junk bonds if you're interested in that. But the Standard & Poor's, or S&P, as in the S&P 500, actually rate every single bond. They rate it on a scale of AAA to D. So D means the bond is already in default. They're already defaulting on that bond. And AAA means it's like the most best bond ever. There's a very, very low chance of them defaulting on that money. There's a very good chance of you getting paid back over time. But again, those bonds with the AAA rating are going to have much, much lower interest rates than the bonds with, say, a B or C rating, because there's much less risk associated with those AAA bonds. All right, so I'm going to make a whole video about municipal bonds in the near future. But what you got to know now is that the government and local municipalities are going to issue municipal bonds, or muni bonds. And these bonds, actually, you don't have to pay income tax on these bonds and on the interest payments that you receive from these bonds, which is very, very significant, because it's going to drastically impact your total return, depending on your income tax bracket and all this good stuff. But just know that on municipal bonds, you do not pay income tax, and that is why with municipal bonds, the interest rate is actually lower for the most part, because they put that lower interest rate in there because they know that you don't have to pay income tax on those interest payments. So you're actually getting the same bang for your buck with a lower interest rate payment on a municipal bond than on a higher interest rate payment on a non-municipal bond, on like a corporate bond or something like that. So you got to keep that in mind, and you got to know that otherwise, besides a municipal bond, you're going to be paying your income tax on any interest payments that you get from these bonds. So because they are an IOU, you're going to be getting interest payments consistently, and you're going to have to be paying income tax on these bonds just as if they were normal earned income, which is not ideal. That is going to be some serious taxing right there. And then anytime you sell your bond for capital gains or you let it mature, then you're going to be taxed as if it was a stock, as if you are holding it. If you're either holding it short term or long term, you're going to be taxed accordingly. So if you hold it for less than a year, you're going to be taxed at your income level rate again for selling the bond. But if you hold it for greater than a year, you're going to be taxed at that capital gains rate, which is significantly lower than however much you're paying in income tax. All right, so that's what a bond is. Now let's talk about why you would want one in the first place. So bonds are actually not just for old people, believe it or not. There is sort of this misconception out there that only old people invest in bonds because they're so boring, they're so non-risky, they're just like something that old people just park their money in. But I don't believe that is the way it should be. I think everybody should, well, maybe not everybody, but I think everybody should have some kind of spot in their portfolio for some bonds, just because they are a very good way to balance out your portfolio so you're not just fully invested in stocks or fully invested in real estate or whatever. I think bonds are a good thing to have in there just to hedge against a lot of different things, because they do move in a slightly different way than your stocks and your real estate do, usually for the most part. So not just for old people, and they're really good at diversifying your portfolio. Like I said, there's room in everyone's portfolio for some bonds. And a general rule of thumb that I've heard quite a bit is that if you subtract your age from 100, that is going to give you the percentage of stocks in your portfolio for your stocks and bonds ratio to your portfolio. So say you're 20 years old, and then you should have about 80% of your portfolio in stocks and 20% in bonds. So that's just how you would use this rule. It's a rule of thumb, so just use it for estimates, but I think it's pretty decent for estimating how much of your portfolio should be in stocks and how much should be in bonds. So it's a good way to diversify your portfolio and create a very strong portfolio that's going to withstand lots of stuff. You definitely want to spread yourself wide for the most part. If you're investing like I do, I'm a long-term value investor, so I like to spread myself pretty wide just in companies that I see as having great long-term potential, and just sort of park my money there and wait for them to grow over time, not looking for any crazy returns in the next 6 months or anything. So that's how I invest. That's just what I do. So it's good for diversifying your portfolio. It's good for a low volatility investment. The bond prices don't fluctuate dramatically day to day for the most part. So you can know that bond prices aren't going to shoot up one day and shoot down the next day. There's not going to be a bond market crash in the near future. Cross my fingers. But yeah, so the prices are just very not volatile at all. So that's a good reason to be invested in bonds. They're very steady stream of income, very steady investment. And if a company actually files for bankruptcy, the bondholders are going to have priority over the stockholders. So the debt equity or the debt finance is going to have priority over the equity finance. So like we talked about before, debt finance, that is bonds and going into debt to finance your projects. Equity is when you're buying stocks and stuff like that, to give away a share of your company. So the people that they're in debt to, if a company is filed for bankruptcy, company X files for bankruptcy, I have a bond in company X, you have a stock in company X. I'm going to be getting paid before you do, because they need to pay off their debts before they can start to worry about paying off the people who have equity in their company. So if you have stock in company X, they go bankrupt, you're sort of left at the wayside. But if you have a bond in company X, then you do take priority, and you might be getting at least some money back from that company as they file for bankruptcy. So that is definitely a pro to bonds. Definitely something that is beneficial about holding a bond. You do have that first spot in line when it comes to a company going for bankruptcy. Next is they can sort of be a guaranteed return. So not always, but like with a government bond, that's pretty close. That's as close as it's going to get really to a guaranteed return on your money. So if you're looking for something that is a guaranteed way to get a return on your money, not just put it in the bank and invest it for the long term, a government bond could be a great option for you, because there's a very low chance that the government is going to default on their bonds. And there's a great chance that you're going to be getting paid in full, and when they say they're going to pay you. So That's pretty much as guaranteed as it gets when it comes to like government bonds. So definitely something to consider if you're looking for something with very, very low risk. And I mean, going with that, probably pretty low returns. But if you do want that, if you're really valuing that predictability and that low risk element of an investment, I think a government bond could be a great, great option for you. Next, it's a great way to hedge in a recession. So in a recession, in general, stock prices are going to be dropping pretty significantly. However, since bonds are less volatile, people actually flee to bonds during a recession, which causes bond prices to at least be stable and potentially even increase, just because people are so scared of the stock market in a recession. They're going to be getting out of the stock market into bonds, and that's going to drive bond prices up. So you can definitely count on bonds to not be as volatile in a recession and potentially even be increasing when all of your stock prices are falling. So it's a great, great way to balance out your portfolio and ensure that you don't have all your eggs in one basket. So during a recession, your portfolio doesn't plunge too dramatically. So that is a great, great way to, or great, great reason to own bonds rather. And next, with this more stable investment, you're going to be receiving much, much higher interest payments than you would be getting from any bank. So it's a great way to ensure you are staying ahead of inflation, or at least not falling as far behind on inflation as you would be by just parking your money in a savings account. So with bonds, you're going to be achieving decent rates of return, maybe around like 2, 3, 4% for these high quality bonds is something you could expect. So definitely at least keeping on par with inflation, possibly even staying ahead of inflation. So that is a great, great reason to invest in bonds. Lastly, getting those recurring payments, getting those recurring interest payments from your bonds is a great source of passive income. So if you're able to just buy a bunch of bonds and then rely on that passive income coming in with all those interest payments, that is a great way to get some passive income going for yourself and with very, very little work required. So those are the pros of bonds, but now let's look at some of the downsides of bonds. Why is everybody not just running out and investing in bonds? Why are they not just the hop and thing? Why don't you hear people talking about bonds and spreading bond gossip at the water cooler, whereas everybody's just talking about stocks? Bonds just don't get any publicity. So why is that? What's wrong with bonds? So the first thing that's wrong with bonds is you don't get any voting rights. So when you own stock, when you're part owner of a company, that actually entitles you to voting rights. So a lot of people don't realize this. If you own stocks in a company, chances are you're going to have voting rights in that company and the company decisions. So you should definitely be exercising those because you do have those and you do have the ability to vote on company decisions. So you might as well. But with bonds, this is not the case. You are just somebody that they owe money to, so they're not going to let you make decisions in their company. In the grand scheme of things and all of their company stuff, they're not going to let you have a say in that. Next reason is there is less risk and less return. So like I said, they're going to be paying anywhere from maybe like 2 to 4% for a good bond. And I mean, that's just not great compared to the stock market average of about 10%. So looking at that, I mean, there's less risk, they're not as volatile, but there's also less return. So people don't get as excited about that less risky investment. They want to risk it all to get like 3 times their money tomorrow, which is one of the reasons that like Bitcoin and cryptos took off so fast. Is people are looking for a way to get rich quick. They're not looking for a way to build wealth over time, which is a great thing that bonds are able to do. They're not going to make you rich quick, but they are going to build your wealth over time. So that's a reason that people aren't as excited about bonds, is that they take a while to actually show the effects on your wealth. It's a slow moving investment. All right, another downside to bonds is that they move inversely with interest rates. So when interest rates go up, bond prices tend to go down and vice versa. So this is kind of problematic because if your interest rates go down and your bond prices go up, then the company that issued those bonds or the government that issued those bonds can actually potentially issue a call provision. So what a call provision is that company actually buys back the bonds from you early, and then you just have this money that you're sitting on, so they pay you back early, which is great, but now you have to invest because interest rates fell, they bought your bonds back early, and now you have to invest this money with lower interest rates. So that can be problematic because if you buy a bond for, say, 30 years and you're counting on, I don't know, a 3% rate of return, all of a sudden interest rates drop down to like 1.5%, and the company buys their bonds back, you now have to invest at 1.5%, whereas you were counting on that 3% rate of return for 30 years. Now you have to invest at 1.5%, which is just not a great scenario to be in. So that is definitely something to be aware of. Call provisions. Be sure you know if the bonds you're investing in have call provisions or not. And call provisions just allow for the company or municipality to buy back their bonds early and potentially put you in a situation where you have to invest at a lower interest rate. So that's not a great situation to be in, but you got to be aware of that from the get-go, that call provisions are a thing, and you got to take those into account when investing in bonds. All right, so now that you know what a bond is, the pros and cons of bonds, if you are convinced, if you're like, all right, I think a bond would be a great addition to my portfolio, I think I could definitely benefit from some bond exposure, how do you actually go about getting some bonds? Well, you've got a couple options. So you've really got three options when it comes to investing in bonds, or three big options that I would recommend. The first one, I would not recommend this one at all, but the first one is to get yourself a bond broker. And if you get yourself a bond broker, you're going to need at least $5,000 usually for a minimum to get started. So not super realistic for a lot of people. There's probably going to be a bunch of commissions associated with that as well. So bond broker, not your top option. But this next option I think is a much better option. It is investing in bond funds, or it's investing in bond funds. So a bond fund is either an ETF or a mutual fund that is composed of bonds that's going to give you a lot of different bond exposure in a small investment. So you can invest in bond funds through any broker that you have, through your Fidelity, your Vanguard, your Robinhood, all that good stuff. You can invest in bond funds, and these can allow you to have much broader exposure. However, there are going to be some fees. There's always expense ratios associated with these kind of investments with ETFs, mutual funds. So you're going to have to pay a little bit of fees to get that privilege of getting all these different bonds put together. And you also are not going to be aware of the maturity date of these bonds. So they're going to be buying and selling bonds in this mutual fund or ETF, and they're going to be maturing and all this stuff at different rates. So you're never going to be sure when the bonds are going to be mature or not. So you really aren't super aware of your investment. You're really just holding on to it, and they're just rebuying bonds and stuff. So you're never really too sure about about what stage most of the bonds in your investment are in. So that's just something to be mindful of if you're not aware of what stage your bonds are at. So that's definitely something to keep in mind. And lastly is investing directly into Treasury bonds. So Treasury bonds are put out by the government, and they're one of the safest bonds around. So I would definitely recommend, if you're trying to get invested with bonds with some low risk, Treasury bonds are the way to go. So you can actually invest in Treasury bonds directly. You can buy them directly from the government by going to treasurydirect.com. That is the government's website where they sell out Treasury bonds directly to you, the taxpayer. So you can definitely go on there and get yourself some Treasury bonds, or just check it out, see what it's all about, see what it would take to get invested in Treasury bonds yourself. So I'll link that in the description. And those are just going to be lower cost, less fees on those, and it's going to be fully electronic. So there's no like paper bond thing involved. It's all just electronic, all online. So that's about it, guys. That's about it for the video. I just wanted to give you guys a rundown of what a bond is, the pros and cons of bonds, how to get bonds, and just answer that question of what are bonds in the first place, because a lot of people just know that there's something that I could be investing in, but I don't. So what is a bond? There you go. If you guys have any more questions about bonds, be sure to let me know in the description below. Otherwise than that, be sure to subscribe, leave a like, all that good stuff. I'll see you guys tomorrow, and until next time.